Hello and welcome. A month can be a long time in financial markets, and so it proved in September with further shifts in global monetary policy, UK fiscal policy and the outlook for inflation. Globally, central banks have continued to raise interest rates as their fight against inflation continues. Another surprise in the shape of higher than expected US consumer price index inflation in early September fueled a third consecutive 0.75% increase in interest rates in the United States. And we're seeing a more hawkish tone from US policymakers of late as the growth in stickier inflation components, such as wages growth, raises concerns. In the UK, a change of leadership has brought about a rapid change in fiscal policy, the new Chancellor's mini-budget being anything but mini in terms of both its potential costs and its transformation of taxation and near-term energy costs for UK consumers and businesses. UK government bonds reacted to the budget with concern, given the actions will increase government borrowing at a time when both interest rates are rising and the Bank of England is shrinking its ownership of UK government bonds. The pound subsequently weakened to an all-time low against the US dollar. That market reaction can be seen really as indicative as to why the former administration was hesitant on implementing such a plan, due to concerns about fiscal discipline and the potential impact of the interest costs paid by the government. The new Prime Minister and Chancellor are no doubt aware of that, and they expect the growth benefits to cover the costs of this package. But it's really important to remember the measures put in place to protect the economy during COVID increased government borrowing significantly, and the previous policy was intended to bring some order to those expanded public finances. So by spending once again while simultaneously shrinking the tax base that will need to pay later for growth prospects today, the UK government has raised the fiscal risk for investors and bond markets have adjusted accordingly. Now, ahead of the budget, the Bank of England also raised interest rates by 0.5% in September, but it's left needing to digest the full budget implications before refreshing its economic projections in November to account for the growth impulse energy price caps and taxation cuts could bring. So the near-term outlook remains subject to volatility as markets digest the greater potential for UK economic growth against the greater UK fiscal risks. Now, in these volatile times, it's worth remembering the long-term nature of investing in financial markets and the need for patience in the pursuit of your investment goals. The end of September coincides with the 10-year anniversary of the launch of Nutmeg's fully managed portfolios, a period that has seen our team guide portfolios through, amongst many other things, a European debt crisis, Brexit, negative interest rates, US-China trade tensions, trillions of dollars of stimulus, several wars, 3 US elections, 4 UK prime ministers, and of course a global health pandemic. Now, over that period, there have been many lows alongside the highs in financial markets, but we're proud to have delivered investment returns that are strongly in excess of our UK wealth management peers, and we've helped many thousands of our clients on their journey to meet their investment goals. In fact, reflecting on this period helps contextualize why it's so important to think long-term when investing. Despite the proliferation of reasons over the past decade to worry short-term, history tells us that the longer you invest, the greater your chances of positive returns. So whenever you joined us over the past decade, thank you again for entrusting us to manage your investments through the ups and the downs, and we hope for a much less eventful decade in the years ahead.